Thanks very much, and thanks as well to all of those of you who are here this afternoon to hear a few brief remarks about our what's been a rapid development of a recently discovered massive graphite ore body in South Australia. We call it the Siviour Graphite Project. Siviour is a relatively recent find. It was only 2016 that we first drilled and delineated a resource at Siviour. At the time, we viewed Siviour as having the potential to become a competitive graphite mine in the context of some of the other graphite developments in Australia. Since that time, we've discovered that there's significantly more to Siviour, more in terms of the truly massive scale of the resource, more in terms of the high quality product we can produce. And then after completing a pre-feasibility study last year and moving on to more definitive studies this year, more to the project economics that would underpin production from Siviour. So 3 years on, I think it's fair to think of Siviour as having the potential to be not just a competitive Australian graphite project, but one that can compete with any graphite development in the world. I'll be talking today about some of the unique characteristics of Siviour and why we think this has a real opportunity to become a Tier 1 graphite mine located here in Australia. Usual disclaimer. So a quick overview. The world needs more graphite. Graphite's like a lot of battery minerals where we have a projected future undersupply, and it needs to be filled somewhere. We don't have a current undersupply, but we're likely to have one, and we're likely to have one very soon, largely because of the increasing growth of electric vehicles. Graphite goes into the anode component of lithium-ion batteries, and accordingly, we're going to need more graphite. We think a lot of it can come from our resource. We think we have a real world-class resource. World-class in terms of its scale. It's one of the largest graphite resources in the world after just 3 years of drilling. But more importantly, we can produce graphite from that resource for a very low cost because of its relatively unique flat-lying orientation and our location, where in an area of established infrastructure, this keeps our costs down. But what really sets Siviour apart in the graphite space and what makes it different is our location. We're located in a low sovereign risk jurisdiction here in Australia. The graphite supply chain is dominated by the Chinese and emerging production from East Africa, but it doesn't have a low sovereign risk source. And we think we have that here in Australia, and we have that because we can produce at competitive prices. The other big difference, I think, in our project is we've gone a different way in financing. The greatest difficulties that most mineral resource companies have, and in particular graphite companies have, is it's difficult to turn a project from a development into a mine by getting financing. How do you do that? It's particularly difficult in graphite because we're largely relying on the Chinese, who are the greatest buyers of graphite. We went a different path. We recently concluded what we think is a real landmark agreement when we're getting Western finance, government-backed, guaranteed from the governments of Netherlands. And I'll describe a bit more about that and why we think that's a real difference maker for our company. A quick corporate overview. We trade on the ASX under the ticker symbol RNU. I'll just call your attention to our cash position here. We're a pretty well-funded company. We had over $4 million at the end of the last quarter. We'll have north of $2 million at the end of this quarter. And this puts us in a very good position to continue to be active as we push forward through 2019. And I guess most importantly, we're funded through to the completion of our definitive feasibility study. We expect that to happen by next quarter. The graphite market. So graphite demand's increasing. It's a battery mineral to the extent that a portion of the graphite that is produced goes into lithium-ion battery anodes. It's the critical element in lithium-ion battery anodes, and that's a market that needs more graphite. We need more graphite because we don't have enough to meet the projected future growth, largely from electric vehicles. So in electric vehicles, we're looking at compounded annual growth rates of on the magnitude of 15 or 16%. And the projections going forward are we're going to be in undersupply. So on the graph here, that area in green is necessary unplanned supply. Okay, so this takes into account current production. There's a large production facility that just went up in Mozambique. This takes that into account. And even with that, we need more graphite. We start to see the supply shortage around 2023. The supply shortage gets particularly acute around 2025. We need more sources for graphite. Where are we going to get these? Well, the Chinese dominate the market. They've dominated for decades, but it doesn't look like that can continue. And for the first time in 2018, the Chinese saw a significant decrease in their proportion of the world market. The Chinese are now becoming net importers of graphite. And that's because the Chinese, in addition to being major producers of graphite, are also the major consumers of graphite, particularly in the battery space. The Chinese are trying to lead the world in the production of lithium-ion batteries, and so they're consuming more graphite for lithium-ion batteries. Now, we've suspected this is going to happen for a number of years, and as a result, new projects have been in development. This has been going on for about 6 years since there was a big spike in graphite prices, and the developments have really been dominated by large-scale developments in East Africa, in countries like Mozambique and Tanzania. But these countries have their own risk, largely sovereign risk. They're high sovereign risk jurisdictions. It's very difficult to raise large amounts of capital to start up large-scale developments in high-risk areas, and also from a customer perspective, it's difficult to rely on continued supply. And while there'll be a place for East African production and also Chinese production, what's missing in the graphite supply chain is secure supply from a low sovereign risk jurisdiction. This is the niche we believe we can fill, and we believe we can fill that because we can do it at competitive prices, competitive with the Chinese and the East Africans. Now, in terms of our project, we're looking at producing about 83,000 tons per annum. We could be in production as early as 2021. Our resource and our reserve is large. We're looking at a resource of over 6.6 million tons, a reserve, so a higher confidence of over 3.6 million tons. So that gives us over a 40-year mine life for a stage 1 operation. But more importantly, because of the orientation of the ore body, it's a unique orientation, it's flat at surface, our mining cost is low, and that translates into very low operating costs. And this is a key advantage. The graphite space is crowded. All markets go up and down, but because we're a low-cost producer, we can produce both in good markets and bad. We also have the advantage of infrastructure. You can see on the map that we're located on the coast. We're in South Australia, about halfway between Port Lincoln and Whyalla. It's an area of established infrastructure, and what that means for us is low capital costs. We don't have to pay for the infrastructure, it's already there. And then finally, the real difference, I think, for our project is we have a clear path towards project financing now, where we have essentially the Dutch government offering to consider us for corporate guarantees. And I'll get a little bit more detail about each of these elements. The resource itself. Siviour is very big. It's a massive resource. It's a massive ore body. We think it's about the 5th largest reported graphite reserve in the world. But also something unique about Siviour is one massive ore body. It's not a situation of different deposits that together make up a project. And this is important for a couple of reasons. As we're entering into more advanced offtake discussions with potential partners, what we're finding is they want consistent supply. We'll always be providing graphite from one ore body. That means consistent supply. The other advantage is a cost advantage. To get into our ore body, we do one pre-strip, and then we'll be into the ore body, and we'll be into that ore body for the life of the mine. Often we have subsequent pre-strips in later years that mean in the later years we have higher costs. We don't have that problem at Siviour. Siviour will be a low-cost operation in year 1. It'll be a low-cost operation in year 10. It'll be a low-cost operation in year 30. In terms of scale, Siviour is far and away the largest graphite resource in Australia. It's really not even close, and we haven't even come close to drilling this out yet. And we really just show this to bring home the fact that this is a globally significant resource. It's a new resource, but it's already become globally significant. The difference maker for Siviour, though, is here. This is a typical cross-section from Siviour. And if you look at it in cross-section, so if you can imagine a 3D slice, it's got thick intersections of graphite that are near the surface. And if we compare Siviour to some other graphite deposits, so here on this image, we've overlain 3 other graphite deposits at scale in the 2 shades of blue and green. You can see that these graphite deposits look different. They're vertical or they're subvertical with a number of lenses. But if we pull back to Siviour, you see it's big and it's flat at surface, and this translates into a low mining cost. The first step is to take that graphite out of the ground and put it on our run-of-mill pad. What we have here is we have a low mining cost, and that translates into a particularly low operating cost. So in this graph here, we compare the potential operating cost of Siviour from our pre-feasibility studies to other graphite developments, not just in Australia, but globally. And you can see that Siviour stacks up quite well. It's a low-cost operating facility. And then again, in the graphite space, we think this is particularly important. The great difficulty we have is financing it. It's important for us to show a large margin between our cost of production and our projected selling price. We're looking at selling our material for nearly $1,000 a ton, but we'd be producing it at under $350 a ton. Metallurgically, after we take the material out of the ground and mine it, the next step is to process it through a processing plant. We adopt a conventional graphite processing circuit. You crush and you grind the ore, and then you go through some flotation stages before you dry, screen, and bag the product. And what we really want here is we want good results and we want consistent results, and we've been able to get that from our metallurgical testing. We're now about 2.5 years into it, so in terms of purity, recovery, flake size distribution, we've gotten good results, and we've gotten them time and time and again at labs here in Australia, as well as key graphite overseas labs in China, North America, and Europe. We've gone through lock cycle and ore variability tests. We've even done pilot plant production using our flow sheet in China, and we've consistently gotten these very good results. Our mine-to-market solution is relatively simple. We're located about 8 kilometers away from the Port Lincoln Highway. We're looking at then taking our material from our mine site and trucking it to the established port at Port Adelaide. We're also about 12 kilometers away from the main grid. We expect to connect to the main grid for main grid's power. We have our land rights that have been secured through an option on the landholder. From a risk perspective, this looks like a low-risk solution. It's also a low-cost solution. It's a low-cost solution because the infrastructure is already there. And again, if we start thinking about project financing from a project delivery point of view, it's a low risk also because of the same reason. The infrastructure is already there. We were granted our mineral lease earlier this year by the South Australian government. This followed about 2.5 to 3 years of environmental preparation, test work, the submission of our environmental reports, public comment period. So we have our mineral lease now. We're going through the final stages to be able to start mining. We expect our final regulatory approvals to happen towards the end of this year. Again, I'll come back to financing. This is the great difficulty we all have in the resource space, in particular the graphite space. We went a different route than a lot of other more advanced graphite developers in entering into a strategic engineering partnership, not with a Chinese entity, but a Western entity. So an EPC contractor would be the group who's actually going to build that processing plant. We worked out an agreement with a large Dutch EPC contractor that has a mining operation EPC arm here in Australia. This is important to us for a number of reasons. First, they agreed to put in $1 million into our project. So they're effectively paying for our definitive feasibility study. And also as part of that definitive feasibility study, they're even moving a step further and doing the front-end engineering work so they can give us their actual EPC proposal to build the processing plant. And what that would do is it would allow us to accelerate the development of Siviour. Generally, you complete a definitive feasibility study, you go out for tenders for an EPC. We expect to basically do those both at once, and then we can turn that definitive feasibility study into a bankable feasibility study. But maybe the most important thing this agreement does is IHC agreed to work with us on project financing. And this took the form of tapping into their project finance network in Europe. So IHC does a lot of work out of Europe. They export material from Holland, and they can qualify for what's called Export Credit Agency cover. Every government has their own export credit agency, and it's a government-sponsored way to promote exports. We have it here in Australia. The Dutch have it in Holland through a group called Atradius. The way it works is if you have a large portion of Dutch content, the Dutch government is willing to guarantee a portion of the project financing. Now, Royal IHC has an established relationship with the Dutch government, with the Atradius group. We don't. As a small junior company from Australia, we'd never be able to get an audience with them. But the fact that we have a Dutch EPC contractor means we can meet the Dutch content requirements. It also means because this group has consistently worked with Atradius, they were willing to consider us. They've given us in-principle support to provide up to 60% cover of our debt. So what that means is, subject to going through normal due diligence, they'd be willing to provide corporate guarantees, and that would allow us to bring in senior lenders. We've already had discussions with senior lenders in Europe and in Australia. They'd be quite keen to finance, subject to getting Atradius on board. So this is the path that we're taking towards financing, and we think it's very different in that we have a legitimate path towards actually financing this. Our development plan, the one that we gave to Atradius, is to produce 83,000 tons per year. The economics are robust. We're producing at less than 350. We'd be selling that at over 1,000, around 1,000 US, an NPV of over 400 million Australian. So the economics are quite robust. This is the case we presented to the Dutch. It's also the case that we're using as part of our offtake strategy. Generally, what graphite development companies do, and most development companies do, is we seek offtake, and then based on the offtake, based on promises to buy our material, we then try to get financing. We've flipped the script a bit because we've seen the difficulty other more advanced graphite manufacturers or development companies have had, so we went first for the finance. Now, we already have an MOU with a Chinese entity, but now that we have a potential clear path towards financing, we think this makes us much more credible with potential offtake partners. So when we complete our definitive feasibility study, we think this is going to be a major advantage for us in negotiating favorable binding finance terms. So after we complete our definitive feasibility study this year, you can expect additional news on the offtake front. A quick word on advanced manufacturing. So the anodes are produced with graphite. The stage one is you produce the kind of graphite we would produce at our mine. The next step in the value chain is to produce a purified spherical product. So this is a downstream operation. You would take what you have at the mine, go through a micronization and spheronization milling process, and then purifying it. We recently completed a pre-feasibility study, and we think this is a very good market for us. It's a good market largely because it's dominated by the Chinese, and the Chinese produce all of the spherical graphite. So all of the natural flake graphite that goes into lithium-ion battery anodes comes from the Chinese. So all of the battery makers, in particular the Koreans and the Japanese, are dependent on their chief competitor in the battery space, the Chinese, for a key raw material. You need new sources. We think we can do this. Now, we completed a pre-feasibility study, and it looks like we can do it on a cost basis that can compete with the Chinese, and it really leverages off of two of the key advantages of Siviour. The first advantage is the low-cost graphite concentrate. We can produce a graphite concentrate at amongst the lowest cost of any graphite development in the world. That concentrate is 50% of the actual cost of producing the spherical graphite. You start with the graphite concentrate, that's half the cost. Now, using conventional techniques, we would then upgrade it and produce a spherical product. The other advantage we have here is our location. To produce a downstream product, you want to be in a low sovereign risk jurisdiction, you don't want to be trapped in a high risk jurisdiction, and you want to be in a modern industrial center. These are advantages we have. So this is an opportunity to double or even increase the value of the Siviour project by more down the line. Conclusions. We're new to the graphite space. We're a new discovery. We trade at a discount to some of the more advanced graphite developers, but we're starting to climb the value curve, and we have some real opportunities going forward because we expect to be busy with a lot of news flow, a lot of key news flows that can help us do it. We're going to be finishing our DFS next quarter. We'll get the EPC proposal, moving on to binding offtake. On the regulatory side, we expect to get final regulatory approvals this year. On the spherical side, we have an opportunity to unlock even more value and to tap in even more directly to the lithium-ion battery space. And finally, as we reach these critical paths, we get into project finance. Our project timeline, we expect to get that DFS done next quarter, final regulatory approvals towards the end of this year. We could be to final investment decisions sometime halfway through next year. That means we could be constructing a mine towards the back half of next year and producing by 2021. In summary, we're a new discovery, but it's a world-class discovery. We have one massive graphite ore body that has globally competitive OPEX, globally competitive CapEx. It's really a tier one project, and now we have a clear pathway towards finance. Finally, best of all, we're located here in mine-friendly Australia. That concludes everything. I just wanted to thank you for your time. If you have any additional questions, I'm here with our chairman, Dick Keevers, will be out in the booth this afternoon. Thanks very much.